Welcome back. This is our most important session. That's why we have kept it in the last. Important for variety of reasons. A, out of the 82,000 crore that Edelweiss mutual fund currently manages, more than 55,000 crore is fixed income assets, out of which 52,000 crore is target maturity. So that's something that we really take pride in. And to talk more about it, I'm really happy to and thrilled to be joined by our fixed income CIO, Dhaval Dalal. Dhaval has spent more than 25 years in the bond markets. There is a reason why we keep calling him Bond. So over to you, Dhaval. Before you start the session, I would request you to introduce your team, and then we can get going with the session.
Thanks, Deepak, for that kind introduction. Let me start with introduction of Pranavi, who is on my left side. Pranavi joined us in 2017 from CRISIL. She joined us as a credit analyst, and she has handled the credit portfolio of our fixed income fund in a fantastic manner. And now I think she has graduated to managing and being co-fund manager of Edelweiss liquid fund as well as Edelweiss money market fund as well, right? And when she's not managing money or managing credit, she is managing her family. She is avid traveler and a reader. On my right side, we have Rahul, who used to manage the liquid fund and money market fund before Pranavi. And he has developed a fantastic track record for our investors in liquid fund and money market fund, being consistently quartile one. And now he is managing all our duration funds along with me.
So thanks a lot. Welcome everyone. Hoping to have a great session today. So Dhawal, before I get into specifics of products and all, since you are here, I would like to ask this question. Bond markets are heading towards one of the most interesting times. Difficult or not so difficult, only time will tell. Rising inflation, tight monetary policy, rising yields, global scenario playing out differently versus the domestic scenario. How would you really advise investors to play this market or navigate this market rather?
Well, Deepak, that's a fantastic question. And, let me just step back to pre-COVID. I think the onset of the pandemic has actually created a completely different investment environment for us, right? Because since March 2020, the global central banks have pumped so much of liquidity and have reduced rates dramatically in order to get the economy back on track. I think in our case, India's economic growth collapsed by about 7.3% because of the pandemic. And now in the last 2 years, while the economic growth worldwide as well as in India is now coming back online, the important thing to note is that because of the kind of money that has been pumped into the economy, now there is a serious issue of inflation, which is coming up in front of all central banks. Now, initially, most of the central banks brushed aside the issue of inflation, calling it sort of like a supply side or transitory. But now I think because of number of factors, including people quitting the job market or because of the geopolitical reason, because of something other factors, the inflation has becoming a little bit more sticky than what central banks would probably be comfortable with. Like for example, in case of India, since March 20, the average inflation has remained above 6%. That's the RBI's upper band of 6%, right? So it's been remaining above 6%. So far, the RBI has focused on getting India's economic growth back on track. But now, as the economic growth is coming back on track, now RBI is forced to look at the inflation number, which is not only becoming entrenched, but is looking to eat into the savings of the people. And as a result of that, now we are going to see the RBI focusing on containing inflation. How they will be able to contain inflation, which is primarily because of the supply side, that remains a mute question, and everyone is looking to be interested into knowing that. But at the same time, there are projections, which are wild projections, which are being made in terms of what kind of rate hike that we are going to see. I think looking at the OIS market, which is one of the ways that market participants predict what kind of rate hike you are going to see, we are looking at about 200 basis point rate hike in next 12 to 15 months. That's again a prediction from the OIS market. I personally do not think that the Reserve Bank of India will go to that extent. I personally believe that the repo rate, which was the policy rate prior to COVID, which was at about 5.15%, we are currently at 4%. I believe that RBI will probably go towards 5.15% over the next 12 to 15 months and then see what happens. Important point to note right now is that we believe that higher interest rates are not going to help economy. And I think investors, while they have to remain invested in the bond market, they should look at fixed income assets, high quality fixed income assets maturing between 5 year to 10 year, because the yield curve is extremely steep. And they should take full advantage of the steeper yield curve right now, and which basically offer them much better tax adjusted return.
So Dhawal, this is really very interesting. Before I move on to the second question, there's a follow-up question on what you just mentioned, the steepness of the yield curve. If you can explain it to our investors, and is this a new phenomenon that you are seeing? You have been in the bond markets for 25 years. How does it really help? Some people just get really, frightened by the word duration when you mention 7 years, 8 years, 9 years, and that too in a rising rate. How do you really simplify this for our investors?
See, Deepak, it's a very important question that you raised, and let me just elaborate on this. The steepness of the yield curve is nothing but the difference between yield of a 10-year paper, which is currently it's a 7 quarter, versus a 1-year paper, which is currently at 5%. So the difference between 7 quarter and 5 is about 225 basis points, right? That's the steepness. Now, people normally look at this from a historical perspective, where over a long-term average, the difference between a 10-year government bond and a 1-year T-bill is about 125 basis points. But because in the last 2 years, because of the COVID and the government losing revenue and they have to borrow more, the yield curve has become quite steep because of the supply pressure and other factors. So investors are getting compensated for increasing the duration of their portfolio, or in other manner by investing in a longer duration paper.
So in simple terms, if you go back in time and look at old FDs, etc., or anything to do with fixed income investing, if you invest for long, you are given a little more.
Absolutely.
So this is how would you like to explain the steepness of the yield curve?
Absolutely, but this time around you are given much more.
So from more to much more. Now let me go back or actually invite Rahul into the discussion. He manages a bulk of our target maturity portfolios. So Rahul, how do you manage your portfolios in these volatile times? Also, people think it's a passive style, passive management. How passive really it is? So what are the challenges that you face while managing target maturity portfolio? I'll come back to you on second question.
Thanks, Deepak, for the question. In the last 2 years, we have seen in the fixed income space, the passive funds have gained a lot of popularity because of the simplicity they offer, the liquidity they offer, and the predictability they offer. Every month, if you see, there has been net inflows in the category. If you see, we at Edelweiss Mutual Fund manage the biggest AUM in the category, as well as we've been very fortunate that we'll be also getting net inflows in this category. The biggest challenge that we've been facing in this category is to source the CPSE bonds, which are part of index. It is very challenging because the price discovery, everything that happens is being a OTC market. It's very difficult to get a fair price and get a supply because it's not a screen traded where we easily get the bonds. So this is the biggest challenge we have faced in the while managing these funds.
So managing.
If I could just also add one important point is that since the pandemic, there has been a sharp decline in the supply of the CPSE bonds in the primary market. Some of the most prolific borrowers like Power Finance Corporation or REC or NHI, they have suddenly stopped raising money. So as a result of that, the primary supply, which used to be the feeding ground for all our Bharat Bond ETF, has not been there. And that, as a result of that, now we have to focus more and more on the secondary market. But we are dealing with this challenge very gracefully.
Thanks. Rahul raised an interesting point in terms of OTC market versus screen-based trading. If you could elaborate the difference between equity passives and debt passive and the challenges that a debt passive manager faces, Dhaval. It will be really helpful for all of us.
Well, you are opening Pandora's box right now, but in the interest of time, let me just say that for equity passives, they have to execute their trades directly on the screen, right? While in case of bond passives, Rahul and our fixed income dealer Hetul will really have to source assets from the secondary market by calling counterparties or calling brokers and waiting for the right type of assets to be available in the right quantity in a right yield. Because just because it's passive, that does not necessarily mean that we can buy any asset at any price, just because it's part of the index. To that extent, it is very important and very challenging, and I must commend that Rahul has done a fantastic job in applying his mind to find out which is the right asset at the right price. Because if tomorrow, if there are inflows in the fund and you just have to keep buying the same asset again and again at any price, it doesn't work for investors. So to that extent, it's a very, very challenging environment. But I'm very, very happy that Rahul and our dealer Hetul have done fantastic job.
So managing passive is not necessarily passive. Dhaval, Rahul mentioned about net inflows into this category. This category now is 80,000 crore plus, which essentially means large sets of investors have really welcomed the addition of this category. I know this is a very favorite question of yours, so let me just ask this question. How do you think your target maturity funds can be used by retail investors properly?
So, Deepak, I think the Indian mentality, I think the target maturity bond ETF and index funds basically appeal to the Indian mentality, which is kitna deti hai, right? So I think the retail and HNI investors, which used to traditionally be invested directly in the corporate fixed deposits or bank fixed deposits or any other instrument where they knew exactly what kind of coupon they'll get again and again. So versus the actively managed fixed income funds where you have uncertainty of returns regardless of the time period that you are remaining invested. So the target maturity bond ETF and index funds have actually resolved a very big question that investors had in their mind. And because of that and other simplicity and lower cost, that investors have really embraced the target maturity bond ETF and index funds since last 2 years. As you have just recently mentioned that we have 80,000 crore worth of total AUM, I believe that we are just barely scratching the surface. If you look at India's deposit base in the banking system, it's almost about 160 trillion rupees, right? So I am extremely bullish on the future growth of target maturity bond ETF and index funds. I believe that we are going to be at least 2 to 3 trillion rupees of this AUM in the next 2 years.
So, Dhaval, before I get Pranavi in, I am tempted to ask a follow-up question on this again. How do you really differentiate between some of the products that are already available in the industry in the form of roll-down funds? I mean, either of you can answer. And target maturity fund. What really target maturity fund does, which perhaps a roll-down cannot?
See, I think the most important differentiating factor in my view is the SID. Or the document.
The offer document.
Offer document. Where I think this differentiates a roll down strategy versus a target maturity bond ETF. Because in a roll down strategy, the SID of that fund, basically it's a do all kind of fund. But it has been reconstructed to do certain things based on the desire by a fund manager. But at the same time, in the target maturity bond ETF and index fund, the investment objective is ironclad. You cannot do anything else. So that is one of the biggest differentiating factor, because tomorrow today a fund manager is doing something like this. If tomorrow he can technically do something else, which nobody can stop it from. While in target maturity bond ETF and index funds, because of SEBI regulation, because of the investment objective being ironclad, there is zero chance of getting anything else other than what is the investment objective saying.
So transparency, low cost, efficiency, so on and so forth.
Absolutely.
Let me get Pranavi into this discussion now. Pranavi, 2017, what a time to enter from CRISIL to Edelweiss fixed income team. So what's your assessment on credit environment as we operate now? And how are the portfolio tilted currently in the times of the credit and duration exposure?
Yeah, I think your first line itself was, inclined towards telling me that it was a tough environment from 2017 till date. And yes, India's credit cycle did come under pressure after IL&FS defaulted in 2018. After that, we have seen a number of defaults and downgrades. And trust me, as a credit analyst, I knew that it spooked not just the investors, but even the policymakers. This led to a widening of spreads between AAA to A rated credits. And as all investors, they rushed towards safety. Everyone was trying to figure out what is exactly happening. As Edelweiss AMC, I think for us to gain investors' trust, we took an immediate call to do only mostly AAA rated assets to ensure that we are giving the comfort to the investors that they sought at that time. Currently also, we believe that, we will continue to do mostly sovereign and AAA in major of our portfolio. However, there has been a lot of positive development over the last 2 years. We have seen a lot of regulatory changes that have happened. Compliances has increased. Owing to this, the investment processes have become more robust. And I think that should just give additional comfort to the investors going forward.
Thanks a lot,
In terms of duration, I think we have reduced the duration of our funds in line with our expectation that RBI may hike policy rates.
Thanks a lot, Pranavi. Dhaval, let me just again bring you in with regards to performance of our products, especially on the target maturity side. I'm talking about last financial year. Beginning of or at the end of the last financial year, 2020 and 21, we saw some bit of rate hike threat and all, lot of volatility in March 2021. And yet we found that target maturity bucket 1 year down the lane did pretty well. What exactly worked and what did not work for others?
See, Deepak, one of the things which is, apart from being very shrewd, one of the things which I firmly believe you need is a luck, right? So as a fund manager, what we saw was that, as I alluded to the fact that while the bond yields October onwards started trending higher, as I alluded to the fact that the supply of primary assets on the long end virtually dried up. And that resulted in a significant tightening of credit spreads between AAA, CPSE and government bonds. And that provided incremental return to the clients and helped us beat even the sovereign fund of the same maturity.
Dhaval, there's a question on laddering. When we launched our Bharat Bond ETF in 2019, we advocated laddering to investors. This is still a very new concept to the Indian masses. If you could take some time to explain this, how laddering can be helpful to investors.
I think, Deepak, the laddering is a very, very important concept. Although I must admit that the time of laddering hasn't come yet, because the laddering normally works efficiently when the curve is relatively flat. What we have right now is a very, very steep yield curve. And as I mentioned to you earlier, that it's very rewarding to the client. Now, what happens is that right now in a steeper yield curve, a client decides to invest either in a 5-year point or a 10-year point, and he can see the difference in the yield and decide whether he is happy to take that additional yield by increasing the duration. But when the yield curve becomes very, very flat, right? And at that point of time, he is investing for longer period, but doesn't getting rewarded for increasing the duration. At that point of time, the concept of laddering will become very, very important. So what happens in laddering is that rather than investing in one point, he or investor decides to invest equal amount of money on all points, say starting from 1 year, 1, 2, 3, 4, 5, or maybe 5, 6, 7, 8, 9, or any other point that they feel are providing them with the solution of the problem that they are seeking. And in that situation, what happens that every time when the one maturity happens, the money is rolled over to the next one. And that way, the money remains invested in perpetuity, but at the same time, it handles the reinvestment risk of that maturity very, very well. So going forward, when the curve becomes steeper, there are certain portion of the ladder that will make money, certain portion will lose money, but by and large, in our experience, what happens is that the average maturity of the portfolio that the client has of the ladder remains pretty much stable. Volatility is extremely low. And as a result of that, we believe that the laddered portfolio generates much better risk-adjusted return than a normal open-ended solution.
So, Dhaval, last questions before we open up for all kinds of questions on all our sessions. We currently have 9 target maturity products, and you mentioned that the yield curve is steep. Which are the maturity segments that you would recommend to investors who are looking to invest, say perhaps from a 3 to 5 year perspective?
See, because of the steepness of the yield curve, my preferred tenure range is between 5 year to 10 year. Given the current yield of 7.3% on the longer dated Bharat bond ETF, and assuming that the average inflation in India remains close to 4.5%, these funds will have a potential to generate far superior risk-adjusted, tax-adjusted returns than even a tax-free bond. So if an investor has a long-term fixed income solution and a surplus capital to invest for longer period, they should prefer to invest on the 10-year portion. At some point of time, we believe that when the yield RBI starts hiking rate, at some point of time, even we'll probably offer even longer solutions.
So that was the next question which an investor had, that would a 25 year or a 15 year target maturity will become a reality? So you already answered that question. So basically you are suggesting 2027 to 2032 maturity for investors who are looking to invest between 3 to 5 years.
Absolutely.
Thank you, Dhaval, for being as candid and as passionate as ever. We come to a conclusion of our fixed income session. We'll again invite our speakers from previous session and our CEO Radhika Gupta to take final few questions and wind up the session today. Thank you.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.